Thanks, Liz. Delighted to be here. So I'm going to take the next 25 minutes or so to talk to you about something called Lending 3.0. It's a topic that's very close to our hearts here at Marqeta. And it's because it's all about how we build a better world for both lenders and for borrowers. Firstly, I want to start by just recapping how we've arrived at Lending 3.0 and thinking about the different stages of lending that we've witnessed over the course of the last 10 years. We're going to look at the benefits of each of these different emerging technologies. I'm going to look at what Lending 3.0 is in detail. We're also going to look a little bit towards the future about what might come next. But I'm sure we can all remember pre-2008, the experience with lending was twofold, really. Firstly, there were not so many lenders around. Most lenders were traditional banks. And there was a very limited use of technology in the whole end-to-end process. Lending 2.0 came along where we started to see what we would call alternative lenders, the likes of Funding Circle, Evoca, Market Finance, etc. And these organizations had two key characteristics. One of them was that they wanted to use advancing digital technology to drive what they did. And also they were seeking to be more inclusive in terms of the people they would be able to lend to. And then we fast forward into Lending 3.0, where lending has become a combination of not just lending money, but also a real-time proposition that's driven by dispersing funds either to a card or to a digital wallet, enabling many, many different use cases, including funds to be dispersed to, let's say, Apple Pay or Google Pay and instantly used in a store. We think about the Lending 1.0 physical journey. It seems crazy to believe, but at one time, many, many loan applications would be the subject of a face-to-face in-bank conversation. If not, very likely to be telephone-based. Whether you were face-to-face or on a telephone, somebody was completing a paper-based application form. And then there was a historical credit check undertaken, and that credit check typically would use a flat credit file from one of the main credit reference agencies, so Experian or Equifax at the time. If you were lucky enough to be approved on the basis of that credit file, and there were many problems with the credit file in terms of its accuracy and the frequency of update, then you may often have to wait weeks before you receive funds into your bank account. And also, as soon as those funds were distributed into your bank account, you as the borrower could expect to start to pay interest on those funds immediately. The actual terms associated to the loan were very fixed, very little flexibility, and very often fraught with early repayment penalties that didn't take into consideration individuals and the different lives and life events that occur. And then if you wanted to top up that loan, it would literally be about going right back to the start of the process and starting again. Lending 2.0 is where we first start to see organizations focus on the customer experience. So speed was one of the most important factors. So applications became online and we could get decision in minutes. So rather than being in bank or going through a telephone call process, we'd go through a process where we could complete a web form and apply for a loan and get an answer back, typically by email, in a matter of minutes. Interestingly, the next big step, which was towards being a more inclusive lending community, was to start to use different sources of data to make credit lending decisions. And this is true whether you are lending as an SME or lending as an individual consumer. So organizations were able to start to use more recent bank statements where you could see how you are actually transacting as a consumer or as a business. And more latterly, with the advent of open banking, lenders can actually, with your permission at least, access your bank account information to get more data points to make better decisions. Also, things started to change in terms of the flexibility of lending. So rather than have a fixed amount of a loan that would be deposited straight into your bank account, you could set up a credit facility and just start to draw down against that credit facility as and when you needed the funds. Repayment terms became more flexible, and you had the ability to top up your needs, again, online, and experiencing much faster decisions with data points much more relevant to who we are as consumers and SMEs. But there were still remaining issues with Lending 2.0. So we still see that inclusiveness often means higher APRs. Inclusiveness can mean higher delinquency rates as well, unfortunately. And as a plethora of new lending companies that have entered the market, added to the traditional banks, there's very limited borrower loyalty. The liability remains on the lender from a very early stage. So as soon as the monies are deposited to the borrower, the liability exists for the lender. And ultimately, from a borrower's perspective, you're still paying interest on those funds that are sitting in your bank account, even though you may not be using those funds right at that moment in time. So the challenges with Lending 2.0 really for us is the fact that there's very limited interaction outside of the initial loan approval. So I apply for a loan. Yes, the lender uses better data sources to make a decision and seeks to be more inclusive. And then I get the monies deposited into my account. But really, that's the end of the interaction for the lender with the borrower. The lender doesn't get to see how those funds are being used. And really, the next interactions are only if there's a payment default or if the borrower is seeking a loan top-up. It would be fair to say that open banking can change this somewhat, but it's still imperfect in terms of giving the lender a true relationship with the borrower where they can build brand loyalty. We look at Lending 3.0 and consider two use cases, the first of which is from an SME perspective. So I, as an SME, could apply for a loan, get that loan approved with the alternative lender using similar sources as just described. So it could potentially be open banking, it could be bank statements. It would definitely be a digital journey, and it would be based around an ethos of trying to be more inclusive and trying to approve more people for credit. In Lending 3.0, rather than deposit funds into a bank account, you have the ability to set a nominal credit limit against the account and only have the borrower draw down those funds as and when they want to make a purchase. And in this example, let's say the SME wants to buy some office equipment. They're online, let's say on Amazon, and they want to be able to draw down on some loan funds. They would be able to receive an instantly issued virtual card that they can use to make that purchase. And crucially, the lender gets the decision as to whether or not to authorize that particular drawdown of the funds by receiving a request for authorization from the card processor. So in this scenario, let's say that the SME has told me that the funds are going to be to buy office equipment. I instantly issue a virtual card, and then when the SME uses that virtual card, it's used on a gambling website. I would be able to receive an authorization request from the card company to ask me whether or not I wanted to authorize that card transaction. And I would be able to see that the intended use of the funds was not that which I granted the loan upon. And I'd have the ability to choose to decline that transaction, or indeed choose to allow it to go through if I so wish. Also in the SME journey, the additional benefit that you get is that you can give individual employees access to cards where they can request drawdown of credit facilities as and when there's a requirement, but that you also have complete control about how to manage that risk through dynamic spend limit controls. It's particularly exciting in the gig economy where we want to be able to rapidly increase and decrease the size of our employee base. It's crucial that our employees or people that are working on our behalf have instant access to funds to complete their day-to-day role. So, for example, with on-demand delivery, but that we don't want to give them a permanent credit limit on a traditional corporate card. So in Lending 3.0, we have the ability to distribute funds safely and securely, and always have the option of being in control of the ultimate decision. Equally exciting from a Lending 3.0 perspective is that, unlike Lending 2.0, where all of the funds are deposited instantly into a bank account, the funds are only transferred to the SME as and when the SME is looking to make a purchase with the card. What that does is create really a series of microloans against an overall credit facility, which both reduces the liability on behalf of the lender and also reduces the level of interest to be paid on behalf of the borrower. Another exciting opportunity from Lending 3.0 is the fact that the use of cards generates interchange from Visa and MasterCard. And we see from our own customers, and one of whom I'll talk about actually, that this interchange revenue gives them the ability to offer lower APR rates against the borrowing, meaning that there's a better deal from a borrower perspective because they can be they're paying less, and from a lender perspective, they can be more competitive in the marketplace. So card-based lending increases visibility, control, and allows you to have more personalized solutions, but crucially, always gives the lender the ability to make a decision as to whether or not to allow the funds to be drawn down at the point of purchase. If we look at a consumer example, so let's take an example of point of sale finance. So point of sale finance traditionally would be a horrific experience where if you wanted to purchase something from a specific retailer and you wanted to finance that, you would need to go to the cashier and complete a paper form or a form even these days on a tablet, very expensive APRs, very time consuming, and a very low acceptance rate. With Lending 3.0 and point of sale finance, I as a consumer could walk into a store, find something I'd like to buy, open up my lender app, apply for a loan, instantly receive a virtual card that can be tokenized into Apple Pay or Google Pay, go to the counter and pay as though I was paying for any transaction using my digital wallet. And the retailer would have no idea that I just financed that purchase, and nor would they care. But from a consumer perspective, the process is considerably faster, much more streamlined, and it means that I have the choice of who I want to use from a lender perspective. And because cards are accepted almost everywhere with Visa and MasterCard, it means that I can undertake this as a lender at any merchant anywhere in the world, as long as I'm happy to lend consumers funds to make purchases from those particular merchants. And again, I have the benefit as a lender of real-time decisions. The borrower has the benefit of real-time access to money to be able to complete those purchases they want to make immediately. And again, they only start to pay interest, if they do indeed pay interest on those transactions, at the point that the purchase is completed. to give you two examples, one on the SME side and one on the consumer side, of two organizations that we work with as Marketer, and two organizations we think have seen significant benefit in their own words from the use of cards within Lending 3.0. So Capital on Tap is an SME lender, pushing the boundaries from an SME lending perspective with their SME credit card and SME loans. Speed is crucial to Capital on Tap, so the ability to issue a virtual card and then to use that virtual card to make online purchases and call against a pre-agreed credit limit is incredibly important. It helps also to automate the reconciliation of transactions into an accounting platform for them. Capital on Tap offers 0% APR for up to 56 days. One of the reasons and one of the driving factors to be able to do that is the revenue that is generated through the provision of interchange from Visa and MasterCard. And from an SME perspective, it gives SMEs great levels of control about how funds that they have lent from lenders, how those funds are used across their employee base. Again, only the exact amount at the point of purchase is the amount that will be taken from the agreed credit limit. So it really helps SMEs have the control they need. It helps them give access to company funds instantaneously, but without losing any control through the dynamic spend rules we mentioned earlier. And it also helps the SME to block transactions by merchant category code. So if I, as an SME business owner, know there are certain category codes that I never want my employees to use my funds from the lender on, I can block them very easily through Capital on Tap to make sure those transactions can never take place. And we've all heard of Klarna, tremendous growth story, great organization. One of the great results that Klarna have seen is the use of virtual cards directly into their consumer mobile wallet to enable them to massively increase the access to merchants that they can give to their consumers all over the world. Again, Visa and MasterCard have done a tremendous job of creating the only true global payment networks that exist. And Klarna have really tapped in to both the security and speed of access to virtual cards and digital wallets and Visa and MasterCard's network to massively expand how many merchants that their customers can access and use their funds with. But they do all of that without the loss of security or control. So the same rules apply as they did in the case with Capital on Tap, that Klarna has the ultimate decision as to whether or not to authorize each transaction at the point of purchase. Klarna can set specific spend controls to make sure that funds are only ever being used in the categories they want them to be used. And ultimately, consumers can do the same thing as well. And a really great quote from Klarna themselves. As a result of issuing cards, we have doubled our transaction volume in 2019 over each quarter. So the ability to massively expand the merchant acceptance network without having to do anything special or create individual and bespoke merchant relationships has been a huge success for Klarna. So if we just recap where we've come from and where we are now. So Lending 1.0, very much provided by traditional banks, very limited use of technology, or at least digital technology, certainly limited consideration for customer experience, and very rigid ways of lending, commercial terms. Lending 2.0, much more focused on technology. So using digital technology to be more inclusive, B, make faster decisions, and C, give a better customer experience, but still not addressing all of the challenges that exist between a consumer and SME, and the lender. And Lending 3.0 really coming in and capitalizing on the use of digital technology, a plethora of lenders with a more inclusive and responsible lending mentality, and also Visa and MasterCard's huge network of card acceptance. And doing all of those things with lenders having the ability to make decisions at the point of purchase and to have controls around how the funds are used to make sure they're in line with how the original lending was intended. So a real shift that's taken place over a relatively short period of time. The point of sale lending has dramatically changed. We all know about buy now, pay later, and its increasing prevalence within our society and how it's used. Yes, there's regulation to come in that area, certainly in the UK, but very often regulation can drive even more innovation and certainly make sure that we only keep the most reputable organisations within the market, and that those organisations continue to deliver excellent customer service and customer experience without increasing risk and certainly without profiteering with very high interest rates. So Lending 3.0 is a massive shift for us. Where next? So what we've started to see in the market, and we believe we'll see more and more of, is we talked in Lending 3.0 how lending companies had started to migrate into more of the payment space. So not just the provider of funds that would go into a bank account where they never have access to the data in real time as transactions are taking place, where it's difficult to build up a meaningful relationship. But in a situation where their own branded card, whether it be physical, virtual, or into a digital wallet, is in the hands of their borrowers, and that they are involved in every single transaction that takes place where their funds are used. And that's crucially important. That transition is crucially important because it helps them make better risk decisions, not just to say no more often, but actually more importantly to say yes more often, where the behavior is as expected. But it also gives the lenders the ability to build up a picture of the individual, but also their customer base to get access to better offers from merchants where they're seeing large consolidation of transactions. Also, we see now is a movement as organizations, as lenders start to understand that lending is not how it used to be. Lending is not a one-time loan facility or I take out a credit card. Lending is becoming a fabric of our financial management. So buy now, pay later, as an example, is prevalent in so many websites that as we make purchases, we often as consumers don't necessarily think about those things as being any different to using our debit card. We know that we don't have to pay instantaneously, but it's just become one of the tools that we use for our everyday financial management. And we start to see lenders who have morphed into be payment providers as well, starting to take a genuine interest in becoming the bank and providing banking services for their consumers and SMEs. So that really a journey that started purely in lending has gone full circle back to banking being provided, lending being provided, and the payments being provided by the same organization, but those organizations being digitally focused from a technology perspective, inclusive, not seeking to profiteer, and looking to give the very, very best customer experience to people who use them. So we expect to see there'll be more automation with embedded finance. We'll expect to see things like you being able to borrow money to fund a train ticket as you make the purchase of that train ticket, as an example, become more prevalent. We expect to see more flexibility in terms of how You can use payment revenue to pay off loans. So as you start to generate interchange on behalf of the lender can use those funds to basically help you pay off your loan. And we'll continue to see more control be able to be exerted by lenders and by borrowers, particularly in the SME space, but not for the purpose of saying no, but to say yes more often to the right use cases for the betterment of everybody's financial management, whether it be consumer or SME. Thank you.